Hello, and welcome back to Ready for More. It's Bianca here. And remember to hit that subscribe button. Thanks for watching. Okay, so this week in our news today, we have some hot off the presses big news in the financial industry. I'm being a little dramatic, but it is good to know the big things happening in the finance world. So FICO has reevaluated how they are going to rate people with the credit scores and what will impact your credit rating. And so first off, I'd like to say I do have my notes here, so I'm going to be looking kind of down, but that's why. So my sources for this are NPR and MarketWatch. As a teacher, you always have to have your sources, so I do. Okay, so first off, the new name for this credit rating is called the FICO 10, and there's a couple of changes that are happening. So one big change is that personal loans are now going to ding you in your credit score. And that never used to happen before. They did not count personal loans. So if you wanted to take out a personal loan and pay off your credit card debt and then have no credit card debt, your credit score would go up. But now they have caught on that people are doing that. And so personal loans are now going to count against your credit rating. So I would either pay that off if you want to, stay at the same level. Obviously, you want to pay it off quickly, right? And personal loans hopefully have a low interest rate for you, so you can pay it off quicker than, say, your credit card debt. The second big thing that is happening with credit scores is they are looking at 24 months of your credit history to check basically how you're doing. So if you don't pay things on time, you're late paying bills, you have a standing balance, whatever the case may be, that is going to impact you in a negative way. And they're going to look at 24 months of history. That never used to happen before. Credit scores used to be a quick snapshot of how your credit was right then and there. And now they're looking into the history. I feel like that's going to impact a lot of people who have been paying off debt and still may have, they might have that, say they started 6 months ago and they have late payments or whatever. That's going to impact them. So the third big thing that is also happening, well, with the 24 months comes, they're going to be checking your standing balance now. If you have a standing balance. So standing balances are looked upon negatively on your credit rating. So this is also going to ding you. And this never used to happen before because they just cared if you paid your credit card every month. They didn't care if you paid it off every month. They just cared if you paid the bill every month. Well, so for those people who have a standing balance, and it's a big one, then this is going to ding your credit score. There's a couple of reasons that I disagree with this or just don't like it. But first off, let me take my emotions out of the equation and just look at this from a pure business standpoint. If I was a lender, this would give me a way better snapshot at how responsible somebody is with money. But now let me put the real world into this scenario and emotion and just my opinion. Okay, so number one, I feel like this is something to keep the poor poor. Because who has a standing balance? Poor people people who can't pay their balance every single month. Who has the money to pay their credit card off every single month? Say they had an emergency and you had to pay $1,000 to get your car fixed or whatever. Who has the money to pay that off? Well-to-do people. Poor people are still going to have that standing balance of $1,000 on their credit card. And Should you use your credit card to pay emergency items? No. And this is why. They're showing you that you should not use your credit card to pay for emergency purchases because they're going to be counting standing balances now. But did people? Yes. Because if you don't have that money in savings, where are you going to get it from? Your credit card. And so now this is going to ding you. Number two, why I don't like this. Millennials are on this path, a lot of us and maybe the Generation Xers are on this path of financial freedom. We call it FIRE, you know. I haven't really looked into the FIRE too much because I'm just on my own little path here, which I will get into in future videos. But we call it the FIRE movement, where we want financial freedom. We're tired of this debt. We got straddled with this debt going to college, okay? We's tired of it. Anyway, so for those of us who have just started this journey in the past 2 years, we're getting dinged. We are getting dinged for our credit history. And yeah, it's only for 2 years, but say you're 28, you're about to start your family. You want to buy a house. And so for a year, you work on your credit, you get things. It used to be you could work on your credit for like a year, boom, get your house. Now it's going to take longer. So I just feel like for the average Joe, middle class people, poor people, this is baloney, if you ask me. But that's just my opinion. So I'm a little upset about how this is going to impact people's daily lives and impact their credit score. Now, NPR does have some good, news. So they do believe, okay, the bad news is if you have a score of a 580 or lower, you're probably going to get dinged 20 points or so. You'll see your credit score decrease. That's what NPR is predicting. However, if you have a high credit score, then you should see your credit score go up about 20 points. And they estimate this is going to impact 20 million people on the low end and then 20 million people on the high end. So we'll see how it goes. And NPR just put out this advice, which is good advice, that you should not use more than 1/3 of your available credit. Just so, don't use that. So here's some advice. Here's some advice for the new credit score rating that I have so far. And, as I learn more about this, there will be new advice coming to you from me. But right now, this is what I have. Number one, pay off your personal loans as quickly as possible because it's going to ding your credit. And number two, pay off that standing balance, which these are all good. This is good advice anyway. You shouldn't want a personal loan. You shouldn't want, a standing balance on your credit card anyway. So it is good advice. However, like I said, on the flip side, you can see how it's going to impact the regular average Joe on an everyday basis. So that is how FICO is changing the credit score rating. And the other piece of good news is that this will probably not take effect for a couple of years because the lenders, the banks, all of that have to get used to, adopt this new process. And we all know how bureaucracy goes. So, at least if you're a teacher, such as myself, you know how that goes. It takes a couple years. So that's some good news. You can get yourself in order and pay these things off so it doesn't impact your credit history. Thanks for watching. Make sure to like and subscribe. Please share this video because everybody needs to hear this. Everybody. It's not the most interesting thing in the world, but guess what? It impacts your daily life on a big scale. So share the video. All right. Have a wonderful day.